Good afternoon, everyone.
96% of traders want to trade for profits. Why not 100%? What if the remaining?
Okay. So, you heard the sound bite. I think, like some of you, like 96% of the traders wants profit, and we should be wondering, like, what about the remaining 4%, right? So that's the part where we are going to discover what 4% wants in addition to the profits. So when we want to make money or when we want to make a trading strategy, then we definitely have to have an idea, and we do not know whether the idea is good or bad until we put real money in it, and we, in hindsight, it's always easy to know if the idea was good or bad, because if we lose money, then that's bad, and if we gain money, that's a good idea. But problem is, like, in hindsight, knowing if it's a good idea or bad idea is not a good trading strategy, because we cannot make money that way. So first we need to have a way to test without putting more money in the market. And if there is a way to test an idea and take only the good ideas, and we have to convert idea into a strategy which should be a tradable thing, meaning like hearing on news like Apple is good, buy right now, is not a trading strategy. Like is not a consistent profitable strategy, because you see many conflicting people talking about buy or sell, and their opinions on the TV or elsewhere on the news or in the internet, right? So so the idea needs to be a tradable strategy where you can identify a clear-cut rules, what the trigger point is, whether to buy or sell, and also like how much money management do you need to do, how much should you risk, so, and what are the exact rules that make you change the initial buy idea to a sell idea. I mean, initially you thought it's a bullish prognosis, but there might be certain conditions in the market, like, which is very dynamic, and that can make you change your bullish prognosis into a bearish prognosis and make you come out of that, right? So there should be, the strategy will comprise a set of rules, and we don't know whether that set of rules are the right rules, or are we leaving money on the table, or are we effectively capturing all the money that market wants to give it to us. That's optimization module. So once you optimize that, and you will be able to, you should be able to create some alerts mechanism, because we can't, reading 1,000 charts a day and identifying about 10 opportunities for the day, it's manually, it's not possible. So once you define a toolkit of good ideas and you design a strategy around it, you exactly know the optimized set of rules, then creating an alert-based system for your trading style is essential. And once you create an alert, then you should be able to configure a study based on the market context, and then start trading. Imagine yourself like going into the investing world without a tool which can help you do all the five of the steps above. It's pretty difficult to achieve that one. So, and that's exactly what Delphian solves. That's the exact problem what Delphian solves, and it helps you test the idea whether it's a good idea or a bad idea. And then once you have a good idea, it will help you design a strategy. And once you have a strategy, it will help you optimize the strategy. And once you optimize it, will help you create an alert. And it can combine all the alerts in different various market contexts and create a study for you. Okay, going into my background, I'm a computer science engineer, graduated in '93, and since then, like, I started working for banks, and then life was pretty good as a software engineer, and fortunately made money. And in '98, '99, when the boom of the stock market, that's when I started the stock market trading bug bit me, and I started talking to my friends, and they're already investing a lot, and they're gaining a lot too, and I jumped into, and pretty soon, like, In 2000, I got the the bad taste from the market and lost all the savings that so far I made from the 7 years of working hard money. So then I thought like stocks became unreal and let's invest in real estate in 2005, and that didn't stay long. Like in 2008, the real estate market in Florida. I'm Florida based, where like Wally and Teddy lives. So the real estate was got a big hit in 2008, 2006, 2008, and that's what triggered me. Like, what's next? Like, I mean, how should I protect the money that's earned like through the hard work, and also like how do I grow wealth? Like, I mean, so that's when like the options interest in options kindled me. Like, and I started learning options and started investing in 2008. So, but unfortunately, there's no one single tool which can help me differentiate the a good idea and a bad idea, and then all the five above steps in one single platform. That's where I saw like, okay, there is definitely a market need. So I quit my primary software engineering job, working for banks, and started Delphian in 2014. And in 2017, we went live beta for the retail market. In 2018, I authored a book which is High Probability Option Strategies for Busy People, which is meant to guide if you have only less time in a day. I mean, how to stay on top of the market and how to identify the trades quickly. And this book explains with it, and the tool also. Once you have access to the tool, you automatically have access to the 9 studies that we publish as a predefined tools in the tool as well. So moving on, like, I mean, obviously, what my challenges are. I did not know what to buy or what to sell, because there were times like, I mean, where in the initial days of 2000, when I bought stock, the stocks did go up, but just because I didn't know when to sell, I could not capture the profit, and I always thought it can go much higher, and also it came down, and I thought like I can sell it once it comes back to the same exact point where I left it or where I bought it, right? So it never happened. So that's one challenge. And also I mean, looking at these, what to buy and when to buy, not knowing that, I wanted an easy solution. And instead of having I mean the the 20 to 30 famous indicators, or the 200 indicators available on the trading platforms. I mean, and there are different parameters for each indicator. Certain parameters work better for one per specific trading model, and certain other parameters work for the different model. So instead of having that, like, I wanted something very simple, which will take all or some of these indicators into a quantitative model, and then do a weightage model. And I designed a proprietary indicator using predictive analytics, and it's called state modeling. And over here you are seeing like a traffic light signal, uh, a traffic light signal, like, which is the green means buy, and red means sell. And here you can see the strength of the color, depth of the color. Like, this 7 is lighter than 1, and so as 2 is lighter than 8, meaning each level of shade of the green color indicates the magnitude of the bullishness. So 1 is a strong buy, and 7 is a buy, and a mild buy, and this is a buy. This is a better buy than 5 and less buy than 1, like so. So it goes like this. So the reason of numbering is like, usually, like, when the market is on the top, then it will be in the state 1, right? It will be in the most bullish one. So then when the small pullback happens, it goes into a state 2, which is a small pullback. And then, so it goes by like a step approach, 1, 2, like this. So so now that we established the state modeling, what it is, like, let's take a look at an example of this one. Like, for example, like CMG on January 10th, 2019, we got a bullish prediction, like most bullish prediction on that it is entering into state 1, and the price on that day was $509. And the prediction, we give about 3 targets, and the 3 targets are meant for different style of trader styles. Like target 1 is meant to address the conservative conservative style of trading, because you probably, I'm a person like who I want like more number of wins, even though those wins are little smaller than the wins that an aggressive person would get. For example, I'm happy if I get a 75% win rate with an 8% target 1, instead of 35% or 40% of the success rate, but with a 20% win rates. I mean, both of us will make money, but the equity curve will become choppy if you are going an aggressive style. There is a chance of not hitting that one as well, like because the price range is a little top. And in my own personal trading style, like what I do is I do scale down. Like when it's if I open about 2 contracts and I scale down one contract at a target 1 and leave the other contract to let it go until target 3. That's my own personal style. Also, like the previous speaker was talking about, I mean, nothing is 100%. I mean, the state modeling also can fail, and so we also identify the stop loss zones. So these numbers will vary from each ticker to ticker, and even though CMG comes back, I mean, on January 10th it came back as bullish. Let's assume that it went out of bullish and came back again bullish into bullish state today. So these numbers might look different because these consider what is the stock market behavior right now in the market, what is the momentum in the market, and using all those other behavioral aspects of the market and the equity by itself, these percentages will keep varying for every prediction. Every specific prediction on that day is only relevant for that particular day. So once we do this, once we got the prediction on January 10th, this is the green dotted line is the day where we got prediction. That was the $509 where my cursor is, and you can see, like, I mean, we hit the target 1, target 2 over here, and the target 3 is hit here. So we also predict like by what date our prediction is going to meet the target 3, and that's about prediction was April 9th. So if you know that prediction, I mean, if you know about the date, approximately how many number of days it will take, and if you know the direction, and if you know what is the price that is going to hit, it should be easy to trade option. I mean, it should be easy to buy a long call option, because you know the option cycle, how many days you need to buy. Here in this example, you are talking about 43 trading days, which is probably 2 months. So in this case, I would buy at least 2 months, a long call option. And I have a choice of buying like a $550, anywhere between $550 to $600, based on how much I want to risk and where I want to buy. Sorry. Okay, so looking at another example, I mean, on the bearish side, Tesla, I mean, we got a prediction on February 19th when the price was $305, and the prediction was it was going to go to target 1 was very a small target, just because of the Tesla's recent nature in the market, and target 3 is about 8%, and few days later you can see like a few days later, like I mean, only within 2 days, second day itself, like it hit that target 1, and target 2 is hit on the second day, and few days later, like within less than a week, it hit the target 3. So if you look at the SPX in the last 12 months, where it was, I mean, right around here on in the beginning of, I mean, somewhere in the month of April, and we are almost at the same point, but the market did go up and the market did go down. So it's a little bit of roller coaster ride, and the reason I say roller coaster is, if you look at the daily volume is relatively higher, the daily trading range is relatively higher than what it normally is in this particular year, in this 12 months. Also, like if you see the lows and highs of the market, I mean, it oscillated between 29.40 to 23.30, I think, 23.40. So roughly around 600 point variation is there in roughly a year, which is almost about more than 25% of the stock market range when it counted from the lowest point, right? So this is one of the biggest year roller coaster ride. So you can see the state modeling, how it grabbed the bullish opportunities right over here and right over here, and the first bearishness sign started over here, and right around the first week of October, and the second week of October like increased the bearishness. By the end of October, like it went into state 8, I think in the middle of November, and then over here we missed the target in about 15 points. The target 3 miss was about 15 points. That's what I call it as a directionally accurate and the target miss. And then we got a bullish sign, recovery sign beginning of January, like this year. Can see a little bit more up close. Okay, now can I use this trigger? I mean, on 5 stocks: Facebook, Apple, Amazon, Netflix, and Google. So whenever the Delphian system says like a bullish trigger comes in, and then I'm going to initiate the bullish trade. Teddy?
Yes.
I lost the connection for a bit. Like, are you able to hear me?
Yes, I can hear you loud and clear.
Okay. Yeah.
I can still see your screen as well.
Okay. That's good. Yeah.
Okay.
Okay. So you can ask me like, okay, can we use only the state modeling and only the proprietary bullish triggers to test this model? The answer is no. If you believe in candlesticks, you can use candlesticks. If you believe in MACD, if you believe in RSI, CCI, whatever maybe your favorite indicator is, the model what I'm going to show you, the strategy design, you can use your own custom indicators as well. So, but I'm going to take you on the ride, like assuming that this bullish proprietary bullish signal is very valid, and if I look in the chart and pinpoint the points where I got the bullish trigger on these 5 stocks in a period of 12 years, going back to 2007 January, we have about 181 data points. Meaning, if I have to relive my trading life and I go back and have this system like in place back from January 2007 onwards, I would have traded this buying a long call or buying the long stock about 181 times. Okay. Now the problem is like, if I want to nail down which option strategy is better, there are multiple option strategies available. Like, there is a magnitude of, you can do a long call, you can do bull call, you can do credit spreads, bull put, and so on and so forth. Like, you can do a covered call, married put, and so on. But for this experiment, like for this presentation, like let's do a long call. Let's assume like every time I get a bullish trigger, and we want to buy a long call. And I'm not sure how many of you are option traders, but I'm going to take a minute and explain what a long call is. So if Apple is around $180 at a stock level, and you think like the Apple is going to go to $200, in options you can buy a 200 call for a fraction of the money. For about $200, depending on the time frame you select. Approximately that price keeps varying based on the time what you select. So for a smaller amount, you can and if Apple really goes to 200 in about a week or 10 days, then the gain is much more higher. So that's what we call it as a leverage through options. So we all want leverage. So the problem is like, okay, which option expiration should I select, and which option strike should I select? Those are the difficult choices when you are transitioning or when you wanted to start trading options and you are currently trading stocks. and there are multiple dimensions of thinking that you need to do when you are getting into the options, pressed into options. So also, like, how much, this is not much different from buying a long call. How much return should I expect when I buy a long stock or a short stock? And how much should I risk, or how much can I risk, like based on the portfolio size? It's always good to have a certain amount of percentage based on your risk tolerance. My personal preference and the best practice is not to exceed 2% of the portfolio. And as your portfolio grows, 2% will give a lot more opportunities, and there are magnitude of a huge number of opportunities in the market. So we don't have to, no matter how much the gut feeling of a signal that is going to be the short winner, also you should limit to your money marketing principles, because that will protect you what if you are wrong scenario. So at the more thinking you do on what if I am wrong, it will stop. Uh, uh, I call it as impulse trading. So it will stop that impulse trading and put you back on track on the strategy-based trading rather than impulse trading. And and when one of the factors that helps us to identify what strike I should select is basically there is a Greek called delta. Delta is nothing but how much of a dollar gain in stock will give you a gain in the option. Let's say you own a long call. In this case, let me take the same example what you are seeing on Netflix. We got the bullish prediction on 4/11/2018 when the stock was about $303, and the target one is 361, target three is $414. So here we are saying average days is 45 trading days. Again, those are trading days, so I would go at least a 60-day option. The reason is, like, I don't want my option to expire worthless, so I want to go a 60-day option. And from a strike selection standpoint, there's a little bit of concept called S-curve. And if you look at, imagine yourself like going on a roller coaster. And when you board the roller coaster, it's in a stationary mode. And once it's a stationary mode, then when the operator starts the roller coaster is going to go a little bit slow up to certain distance. After that, it takes momentum, it increases momentum, and it goes very fast, and then it stops again when it's coming to the end, stops again, slows down, and that's exactly what happens to the options. Let's say in this example, if you buy a strike which is 30 delta, and let's find out what strike is that. So it's around 340 delta, which is 32 delta. Let me 340 delta, which is 32 delta. And now if I buy this, and remember the stock is only around $303 when we are buying this one. So if the stock goes to 340, then this 30 delta will be shifted to 50 delta, because that will become at the money. So that's how the delta will keep increasing as the stock is approaching your strike. You keep adding more cents in profit for every dollar gain in stock. So thinking of another way to look at is, there is something called extrinsic value and intrinsic value. Intrinsic value is basically how much of the option price is already built in because the strike is lower than the stock price. For example, if you take the $300 strike, and since the stock is at $303, $22 of nearly around $23 of the option price is extrinsic, and only $3 is intrinsic because the stock is at around $300. So if you go to the next strike, 305, there is zero because it's outside of that stock price. So anything above the stock price on the call side will have only extrinsic value. Extrinsic value is made of only volatility and the time value. So if the stock, and also 80% of the out of the money options strikes expire worthless. So what that means is, basically, if you look at this particular chart before we jump onto that, you see this extrinsic value is highest at the money, and when we are buying out of the money, and the stock is moving to the out of the to moving to 340, then the extrinsic value will be highest. That means the value will be popped, will be exploding. The option value will explode when it becomes an at the money. That means when the stock price really goes to $340, that's when the option price will be at a maximum exploded value, and that's exact point where you want to sell the option, like one way of selling the option, because when you sell you want to get more, and when you buy you want to pay less. So that's why you're buying far out of the money option. But if you go too far of the money option, there is a risk of expiring worthless. So we want that at a sweet spot of right around this point, like where the 330 point is there, where the escalation is the highest. Meaning, once it reaches, if I get on to, let's go to the roller coaster analogy, and if we can get into a roller coaster where it accelerates fast, if there is a way to get in there and get out when the acceleration slows down, then you are maximizing your time, you are utilizing your time. But in that analogy, in the real roller coaster, it's not as safe to do that. But luckily in the options market, you can get in anytime, you can get out anytime, right? So that's how you are managing that effectively, getting into a position at a right time and getting out like at a right time. Now that we nailed, I mean, around 60 days is the option strike. That's the model which I'm going to select. And right around 30 delta is the sweet spot for the escalation path to be there. So now I clearly know what strike I should select. The big question is, I mean, the 300% profit or 200% profit or 100% profit. And you'll see a lot of advertisements, like a lot of people marketing, that you buy an option, you want to get a 300% profit. Risk $1, get $3. But I'm here to tell you that happens only 30% of the times. So that's exactly what I'm talking about. The aggressive trading style of expectation should be around 300%. But if you want a conservative trading person, your profit target and profit target management should be lower than what you see out in the marketplace, where you see people advertising that one. But let's assume, like, I mean, let's take like list of the advertisements what you see, like 100%, and let's see the model, like if expecting 100% is a good strategy or not. So in this example, I mean, the Netflix, like I'm just showing you that's the place where we are, where we bought a 340 call, and the stock was around $300. Few days later it hit, and this is the right point to exit. But in this case, I did not exit, but I went for 100% profit. So I had to wait a little longer. The first exit point was here. I could have exited because the exploded value when the stock moved from here to here, right? So it has a more exploded value, more explicit value inbuilt into this. So imagine yourself taking off around, could be 30 or 40 or 50% profit, less than 100% profit, but your trading days is only about 7 days, versus the waiting for the 100% profit longer, and you have to wait for more than at least a month, right? So in our business, in the trading business, money is inventory, and you want the money to be turnover fast, your inventory turnover fast, so the more money will be working for you on the other opportunities. So in this case, I mean, I took 100% profit target and said, out of these 5 stocks, we looked at, we generated about 181 entry points, and we bought a long call which is 60 days out and a 30 delta, and based on those parameters, out of 181 data points, we got 111 wins and 70 losing trades. So which gave us about 61% win rate and a positive green dollars. And the one I want to draw attention to 2 institutional metrics, style of measuring: the profit factor and the efficiency. profit factor is defined like the number of the ratio between the gains and the loss. That means for every dollar lost, how many dollars you gained. That's what the profit factor defines. Again, the ratio between the gains versus the dollars lost. So for every dollar lost, how many dollars did you gain? So in this example, for every dollar that's being lost, there is a $2.47 gain. So let's say like if I'm ready to give you, every time you win, I will give you $2.47, and every time you lose, I will take $1, and the win percent is 61%. Think about it. I mean, would you make profit at the end of the day? Because you won 61% times, and you got more than double every time you won, right? So the efficiency is basically the power of converting the paper gain into a real profit. Meaning, market always tries to give you more money, but we don't know whether that is the top of the market or whether there is still more money left on the table, right? So we generally don't close it at the right time. So that's what the measurement of the efficiency is. If it's, I mean, the maximum you can go is 100% efficiency, but in a good strategy designing model, if you go beyond like tuning it beyond 70% efficiency, you will fall into analysis paralysis. You will never be able to trade. So anytime you see a more than 70% efficiency, I think that strategy is a reliable strategy. Like with a greater than 60% win rate, with a greater than profit factor of 2.0, that's exactly what we are looking at nailing down. Like, yes, this is a strategy that has a high probability success rate. So in Delphian system, I mean, there is one single screen. I mean, where you need to input all what we talked about. I mean, you can with one click you can find these 181 data points, and once you find that 181 data points, I mean, where there is a bullish trigger, you just input, like you say, long call. I'm going to manage this, close this trade if I get 100% profit, and I'm going to select an option expiration cycle that is 60 days out, and a strike based on the 30 delta. And in a few seconds you will see the result like what I'm showing you on the screen. And the question is like, can I improve this winning percent? Like, I mean, can I improve a profitable strategy? I mean, you may ask, like, it's already profitable, why improve, right? So why to lose money on the table is a bigger question. The second is like, is expecting 100% too much for this kind of trigger and for this set of rules? And so for that reason, what I said is, okay, I'm going to lower my expectation from 100% to a 50%, and will it make money? And here you can see, did it make money? Yes, the answer is yes, it made money, and it made 75% of the times, and it gave me a profit factor of 3.16, which is more than 2.47, and it increased the efficiency as well, and it gave me more profit dollars for every day, and it reduced the number of days in trade as well for the same dollar amount of risk. And obviously, I mean, the percentage of win percent more, so you'll see the number of trades also win percent is more. I did one more thing. I went one step ahead and said, like, okay, let me drop it to 25% and see if it makes sense. And now my win percent, again, as expected, it increased win percent to 84%. And so as efficiency is increased and the PL per day is increased and the days reduced. So this is a classic book example. On the metric side, every metric is showing a strategy improvement and optimizing that one. Even though you will see the dollars being reduced on the profit dollars, 85,000 to a 75,000 to a 60,000, but remember, you are making these in less number of days. So if you make less, but on a per day basis you are making more, your inventory turnover is working for you, and you are leveraging your releasing your money that's being locked on these opportunities for other good opportunities. Now, on the fourth test, what I did is I included a secondary filter and said, out of this 181, I will not rely only on the Delphian proprietary signal. I will add a MACD indicator because I like the MACD bullish indicator. And when the trigger happens, MACD also need to confirm that it is in bullish state. So when I added that one, it triggered off. It rejected around 111 trades, and it accepted only 70 data points. That means around only 38% of the time you are trading, and your win rate increased to 90%, and there are only 7 losses. And if you look at the profit factor, it almost more than doubled. I think it almost doubled the profit factor in terms of profit factor, and also so as like it doubled the profit dollars per day, and it reduced the number of days. And once you do this, I mean, you can also generate an English text report like this. I mean, you want to share it with your friends, or if you are part of the meetup group, or some, I mean, if you are 10 buddies, like, I mean, trading together, I mean, you can share this English report. That way they get a English understandable, like, I mean, there's no miscommunication across the people in terms of sharing knowledge. And once I know, I mean, I like the model, what I see. Now let me lock these rules and have Delphian look for the opportunity when the bullish trigger happens. Now Delphian system knows your entry rules, that it needs to have a proprietary bullish trigger plus the MACD bullish. Then when that happens, you already told the Delphian system that you are going to buy a 60-day option and you are going to buy 30 delta. So it automatically identifies the strike and lets you know that, hey buddy, like you have a trade to make, and here is an email like for the trade. And after that, like with our membership, like you can trade commission-free trading for stocks and options when you open an account with our brokerage partner. So in this book, like what we did was, I mean, we used the system, and we have used our trading experience and created 9 predefined models, and the book explains about it. And if you look at these graphs, like we went and measured, like starting from January 2018, how many number of trades that the tool has been identifying. And if we traded only one contract, no matter what the size of the dollar risk what we are making, but if you trade only one contract of all the strategies, then like the way to read it, this one is, see, there are roughly around 1,200 bull calls that are identified in the last 12 months, 14 months, from January 2018 to February 2019. This includes the Q4 last year, which is a bad quarter. And the success rate is around 80% out of the 1,200 trades, the win percent. And when you come to bull put, the success rate is around 85%. I think it's slightly identified more than the bull call number of trades. And the long calls, there are around 1,000 trades that are identified. So this way, if you look at strategy wise, I mean, like a study wise, and this study number 6 and 7 identified maximum number of trades, and the other trades like right around this point. You might, I mean, the book explains about what each study is about, and will help you understand that as well once you open up a trail. And if you are looking at the study number 4, which is what you are comfortable, you would have got around 500 trades last year. So if you are paying for an advisory service, someone to tell you what to trade, and this, I mean, that itself will more than pay for this one, as well as for commissions as well, and you get an opportunity to learn how to trade using an efficient tool. And I have an amazing team, Josh and Sean. And Josh is ex-Navy, and he was is a financial advisor for worked in Merrill Lynch and Wells Fargo before he started working with Delphian. And Sean has been always a equity trader, futures trader, and options trader. He's a mixed bag of trading skills. So these two are the individuals who designed most of the studies, and I am responsible for creating the tools, and these guys are responsible for doing the actual trading studies, like so. And these two are the individuals like whom you will speak to for most of the time, like when you are getting onboarded onto the Delphian platform. And I mean, last week and a half, like I was there in New York Expo, we offered a special, and the special is first month $10, and we also offered like a 50% discount for the people who signed up at the show. And right around the time frame, like when Teddy called me to and asked me like to participate in this Traders Live, so we decided to extend that. And to sign up, like you can go to our website, delphiantrading.com, and open up a trail. And once you open up a trail, then in this and through this one, like I mean, we can let us know that you are from this group. We will apply the 50% discount automatically. Okay, and if you an easy way to reach us is like via the email, like info@delphiantrading.com. Also, like sorry, there's a question slide. Yeah, you can reach us at 813-330-0900 as well. Any questions? We still have time. Teddy, are you on?
Yes, I am on.
Okay, looks like there are no questions. Yeah, thanks a lot for the opportunity.
There's
Teddy.
one question, actually. There's
Sure.
one question. From Mr. David Merlin. He said that he did not know how to use option chains. He said that he finds it very confusing.
Okay, yeah. So it does need a little bit of practice, and the way the Delphian tool comes in, it comes with graphical view of the representation of the Greeks. So we make it a little bit more easy. Like so, the book also explains like how easily to grasp the options chain concept. Like so. Shouldn't be that difficult, but it does need a little bit of practice. Like so, and we can help you once you talk to Josh or Sean. They will be able to help you that.
Okay. Okay, he said he will call.
Sure. Okay. Yeah. Thank you, Teddy, and thanks for the opportunity.
You're welcome. Thank you for coming out.